Yo, 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 what's going on, everybody? I want to talk to you guys today about how to produce income using a debit spread strategy, okay? So, this is a strategy that you can implement when you believe you're confident that a stock will stay where it's at or move in a certain direction, okay? So, let's say you have Meta, for example, and you believe that Meta is doing good right now. For whatever reason, you think Meta is going to stay where it's at, bare minimum, or maybe it's going to go up, okay? And this would be a strategy that you may want to implement. It's not financial advice. You will lose money. Make sure you like the video. Make sure you subscribe. Make sure you check out the Substack. But it's just something that I want you to think about. It's something that I feel like you should be knowledgeable of and know how to implement this strategy. And it's a good way to generate just, 10%, 5%, 12%, every 2 weeks, every month, whatever it may be. And at the end of the year, that's a lot of money, assuming that your trades are winning, right? So let's go over it real quick. So let's say you have Meta, for example, right? And as you can see, my expiration, April 14th, right? 2 weeks out, 14 days, right there. Let me zoom in a little bit so you can see a little better. Okay. So what you're going to do is, this is a call debit spread, an in the money call debit spread. Okay. It's very important you understand in the money, out the money. So right here, you can see the share price is at 207, right here, 207.83. Okay. So anything above this is out of the money, okay? Anything below is in the money, all right? So when you're in the money, you just need the stock to stay where it's at for this trade to work out. But when you're out of the money, you need the stock to move into your direction and become in the money before the expiration. So you can see how that's much more risky, okay? But you get rewarded for that risk, obviously. The universe is balanced, okay? So what I'm showing you, though, is in the money call debit spreads. And this is an income producing strategy, okay? Because you're expecting the stock to bare minimum stay where it's at, all right? If it moves up, that's great. But as long as it stays where it's at and the 2 weeks goes by, you're going to collect that money, all right? So let's say you're confident that it's going to stay above 200, all right? So what would you do? You're going to buy the 197.5 right here. So you're going to hit the plus. You need level 3 options enabled on your account to be able to do this debit spread strategy, okay? To do spreads, period. Then you're going to sell the 200 strike, okay? Boom. You sell that. And as you can see on the little side diagram, you see that it's going to cost you $190 to do this trade. But your expected profit is $60. So as we get closer to that expiration, right, you're going to fill out the difference between the two strike prices. So the strike prices were 190 and 197.5 and 200. So that's a $250 difference, right? So that is the max value that this trade can grow into, okay? And as time goes by, because you're in the money, as time goes by, your option, that 250 is going to fill out. So you can picture right now it's at 190. It's already pretty full. It's because it's in the money that it's already pretty full. But that last $60 is going to fill out with time, all right? Because your one contract that you sold is going to decay in value, okay? So right now you have 190 and boom, you would make $60. So now before you would place these trades, you got to be thinking, what's my ROI? What am I looking at? Is this too risky? Could I do something less risky, a little more safe, collect less ROI? So you want to play with these numbers. You want to think about these things. So you do 60 divided by the 190. Boom, you're at 30%, 31%. That's huge. Okay, that's a huge ROI, which means that you're taking on some risk. If you're generating such a big ROI in 2 weeks, think about it. If everybody was doing this trade and always winning, people would be making 30% in 2 weeks. That's crazy over the whole year. So now you could do something less risky. Okay, maybe you're like, I don't need to get 30% in 2 weeks. So maybe you're like, what is it going to give me if I do the 190 strike? Right? So now if you do the 190, you only need it above 190 for it to work out. So you would buy the 187.5, right? The more expensive option, okay? And then you sell the cheaper option, okay? For 19.18, right? See, that one, it's costing you 250. Boom. So it's already filled out. And that's because the spread, the bid ask, it's not going to work out for this trade, all right? Maybe you get it for $2.45. Maybe you can milk $5, okay? And 5 divided by $2.45, you're looking at a 2% return. But hey, if you're able to get this option, let's say you put it in for $2.45. If it hits at $2.45 and you let the 2 weeks go by and you make that $5, guess what? That's 2%. If you do that all year long, you're looking at 50% at the end of the year. So that would be nice. But let's try maybe you try the 195. Let's see what this looks like. So you buy the 192.5, you sell the 195. All right? See? Boom. This looks nice. Cost you $213 and your expected profit going to make 37, right? It's always going to be that 250. So, what's that? That's 37 divided by the 213. That's a 17% return in 2 weeks, okay? These are trades you can do to generate a little bit of cha-ching income into your portfolio, okay? So these aren't like the 5x to 10x trades that are way out of the money that we're doing elsewhere in our portfolio, okay? You can be doing both of these things in your portfolio. So this is something to think about. This is a way that you can generate income in your portfolio when you're confident that a stock will hold its current position or move in your direction, all right? You can do the same thing on the short side. If you think a stock is bearish, you're bearish on a company for whatever reason, and you think it's going to stay where it's at or go lower, you do the same thing but with buy puts, okay? So sorry. I mean, you're buying and selling a put, but you get what I'm saying. So let's say you're bearish. Let's say you think it's going to stay below 215. Okay, let's say you're bearish on Meta. You're like, it's going to stay where it's at. It might go lower. Okay, so you're going to buy put, right? You always buy the more expensive one. So you buy the 217.5 and then you sell the 215. All right, boom, right there. It's going to cost you 183, and your expected profit, you're going to make 67. So you can see how the market is expecting Meta to go up in a sense, because on the right, we're 2 strikes out. Okay, maybe not, but it's about equal. It's about equal on both sides. But this is the same thing, but a bearish outlook on Meta. You're trying to produce income on the bearish side. Okay, so that's a little video that I have for you. It's a little options lesson, income producing strategy that you can implement in your portfolio. None of this is financial advice. You will lose money. Make sure you like this video if you found it informative. Make sure you subscribe as well. Hit the bell notifications and check out the Substack. In the Substack, I'm telling you what plays I'm actually doing. Okay, I'm not as financial advice, but I'm just sharing with you what I'm doing personally in my portfolio. So stay healthy, stay wealthy, and stay tuned for more.